Good morning. It's Jeffrey Christian of CPM Group. It's about 10:50 in the morning on Tuesday, the 6th of May here in New York. Gold's trading around $3,396. It did touch, the June contract did touch 3,400 today. The reawakening of investor concerns about the state of the economic and political environment, both on a global basis and in individual countries, especially the United States, has come back into focus after having waned a few days last week. And we're seeing gold and silver prices stronger again. Silver is around $33.34. Right now, it got up as high as 33.43, lagging gold somewhat as it has been, but showing some strength. I want to talk about the volatility that we've seen in the political and economic environment and in precious metals prices. And specifically, I want to talk about the economic environment. Our view has been and continues to be that the economic environment will be very volatile, as will the political environment. This is a chart of U.S. Consumer Price Index going back to 1947 or so. And the Fed will be meeting this week and will decide what it wants to do, if anything, about monetary policy adjustments. Our expectation is that the Fed will probably leave interest rates unchanged and say that it's continuing to watch both employment and inflationary conditions carefully, because we seem to be at a point of where we might see some major developments there. But you can see that inflation, which had spiked up after the COVID lockdown and gotten as high as about 9%, has come back down. It's been trading around 2.6, 2.8% in terms of headline inflation, and in terms of core inflation. We've seen some wild moves in the oil price, and the oil price has come down further in the past few days, which will probably lower the CPI, be the major factor in suppressing the CPI data for May because of rising prices in other markets. But the energy market is much more volatile. So we're seeing inflation down from 9%, still not near what the Fed considers a suitable target at closer to 2%, and nowhere near the 12% or 14% that we saw back in the 1970s. So the inflation environment is still somewhat problematic for the Fed. The Fed pays more attention to the personal consumption expenditure price index, which actually is showing about the same kind of activity. Prices somewhat lower than we had seen, but still higher than the Fed would like to see. So from an inflation perspective, the Fed is saying, okay, we have problems on the horizon we have to pay attention to, and that would caution us from lowering the interest rate very high. On the flip side, the Fed is also charged with trying to maximize employment. Unemployment rates are very low. You have seen an increase in the last year or two, but the unemployment rate, it really harks back to the 1950s and 1960s, which a lot of people think were the glorious days for the U.S. economy, and they were much stronger and better than they have been since the 1970s. But unemployment is far below what we saw throughout the 70s, 80s, 90s, and aughties into really the 2000 teens. Unemployment is there, but they look at employment. Now, employment's a little bit scary. You can see on the left-hand side, these are the total number of jobs, and they've been growing, but so too has the population of the United States. So what you have to do for employment is look at the year-over-year percent change in total non-farm employment. And that's on the right-hand side here. You can see very volatile in the 50s and 60s, late 40s, 50s, and 60s. That's some of that volatility that we saw during that period of time. It was relatively strong in the 60s, and then it got a little bit more volatile in the 70s. After 1980, you saw that the employment growth figures rose and fell cyclically, but basically were in the 4% or lower rate of growth in employment. And we spiked down during the COVID lockdown. We spiked up in the post-COVID expansion, and we're back down to basically the kinds of growth rates in jobs that we've seen for most of the period of time since 2000, 2002. So the Fed is looking at trying to balance employment growth and overall economic activity and inflation. You don't want the inflation to run away, but you also don't want to throw the economy into a recession. Unfortunately for the Fed, that's its charter. That's what it's supposed to do. But unfortunately for the Fed and other central banks around the world, to some extent, they have been distracted for decades from their stated purpose of trying to help stabilize the economy and protect depositors from bad behavior on the part of banks. It's the Fed and other central banks have been distracted from that by the need to deal with the monetary requirements to support deficit spending on a ongoing, unethical, unsustainable basis. And so the Fed and other central banks wind up doing a lot of things that might not be what they want to do in terms of trying to keep inflation down, but the economy strong, because of the bad fiscal policies that governments present them with. And that's the way it is. You can also look at GDP as opposed to employment. The Fed's charter is employment. But if you look at U.S. real GDP, we saw a negative 0.3% growth in the flash estimate for the first quarter. It's not clear that that'll be there. There's a lot of things going on with tariffs and people buying cars in advance of tariffs and people buying car parts and such. So the GDP has been skewed to some extent. The biggest negative in the GDP in the first quarter flash report was a sharp rise of imports, people bringing stuff into the United States in advance of the tariffs, anticipated tariffs, threatened tariffs, whatever you want to call them. So from a overall economic perspective, as opposed to employment, the economic activity and the outlook is a little bit more worrisome, looking at historic data through the first quarter. And the dollar has come off. You keep hearing people about the dollar reset. Nonsense. The dollar collapsing. Nonsense. The dollar hasn't been as low as it is today since October, 6 months ago. And you can see here, this chart goes back to 2006. The dollar has been stronger really since 2022 than at any point prior to that, going back all the way to 2006. So the dollar has come off from a high, but it's not collapsing. He who bets against the dollar loses. These are CPM Group's projections for global GDP going forward for the next 10 years. We have a recession built in coming in 2025, 2026. And then we have a recovery that is more anemic than has been past recoveries over the 90s and the aughties and the teens. So we're looking for longer-term economic and political prospects that will be more hostile than they've been for decades, for half a century really. And that will support investment demand for gold and silver, and that will support gold and silver prices at higher levels. Now, looking at a collapse. Now, seeing more volatile economic and political environments, we're seeing more volatile precious metals prices. But if you look at them, and I apologize, this date is only through March. We're working on our April precious metals advisory this week, and the data will be updated through April. But if you can see here, through March of 2025, the volatility in gold and silver prices was pretty much within a typical range. In gold, the typical monthly volatility for gold prices is between 10 and 20%. And in March, it was around 11%. It's probably going to be around 20% for April. April saw a much more volatile market, but we're still within that range. We do think that the volatility will spike up as it has in the past over the next year or two. But for now, for all of the drama that you've seen in gold prices and in silver prices, it's really been sort of within range. Silver's been more volatile. The volatility in March was 24%. That was higher than the 20% in March of 2024, and it was up from 20% in February. But again, it's still, for now, through March, in that range. So the volatility in economic and political environments has not, as of the first quarter, spilled over into gold and silver price volatility. It probably has in April. We just don't have the data, or I don't have the data available at this point. So that's something to pay attention to as we see the data coming through. If you look at gold prices, as I said, they've spiked up as high as 3,400 today. Over the previous days, they had come off sharply and gotten down to around $3,209 in last Thursday. They've come back up. Our expectation is the prices will continue to be volatile with an upward bias. We saw 3,500 briefly in April. We expect to see 3,500 again in May. Then the price may come off for a few months. But given the overall economic and political outlook and conditions, our expectation is the price is going to stay high and probably move to higher highs. Similarly for silver, silver didn't perform as well in April as gold did. That reflects, I think, stronger and more universal investment demand for gold than for silver. We did see the silver price come off sharply in early April, along with gold and other assets. It came back, but it has not come back to where it was in late March. Our expectation is that the silver price will continue to be volatile, but with an upward bias. We wouldn't be surprised to see $35 silver again within the next several weeks. And then as with gold, we might see prices calm down for a few months before rising further. Platinum and palladium primarily are industrial metals. Their major use in each metal's case is in automotive catalytic converters. The auto industry is facing a number of long-term secular as well as cyclical headwinds, which are causing production and sales of automobiles to decline. Within the auto market, you're seeing a continued growth in electric vehicles that do not use platinum, palladium, and rhodium in catalytic converters. Half of the electric vehicles are being manufactured and bought in China. The bulk of the rest are being bought in Europe right now. But that is a longer-term reduction in platinum, palladium, and rhodium requirements in the fabrication side. As a consequence, you have ample platinum and palladium supplies, and that's keeping the prices moving in a sideways basis. Our expectation is that that is going to continue, both for platinum, seen here, and for palladium, as Palladium was $985 when we started this video. Palladium was $957.50. That's all I have. We will be doing our open forum for our clients on Thursday, May 8th, in 2 days at 11 o'clock Eastern Daylight Time, not Eastern Standard Time. It's challenge your assumptions. We don't have a formal presentation. Clients send in questions ahead of time and ask questions over the course of the event. It can be very interesting. We usually get far more questions than we have time to answer. We already have quite a few questions about silver, platinum group metals, automotive use, silver market conditions. We're looking forward to it. We also have some questions about gold. So that's coming up this Thursday. If you're a client, you can plug into that. If you're not a client, you can go to our website and become a client in the next 48 hours. In addition to that, we'll be coming out with our silver yearbook later in May. We're working on updating the statistics and analysis right now. You'll see that we do have a surplus, and we are expecting investors to increase the amount of silver they're buying over the course of the next 3 quarters, the rest of this year. I'll be speaking a couple times at the Society of Mining Engineers New York chapter's Current Trends in Mine Finance, which is a conference that goes on from the 19th to the 21st of May here in New York. Murdoch Capital Partners, working with OTC Markets and TAA Advisory, are putting together a precious metals and critical materials conference in May. I'm speaking that morning on precious metals, and then I'll be speaking about gold at the Astrologers Fund in June. You can go to our website. You can buy our gold yearbook, which was released in March. You can pre-order our silver yearbook and our platinum yearbook. You can subscribe to other publications, and you can read about a lot of the services that we have for investors and industrial commercial entities that are involved in these markets, as well as governments. There's a tremendous amount of historical information on our website. You can buy reports, subscribe to reports, and you can send us an email at info@cpmgroup.com asking us to discuss with you how we can help you better manage your price exposure to commodities and precious metals. That's all I have for now. Take care of yourself. Take care of those around you. Try to do something good for the world, and we'll speak to you on Friday.